You spot a breakout above a previous high. You buy in expecting a massive run, but the market immediately reverses and triggers your stop loss. Instead of getting caught in these false breakouts and losing capital, we are going to look at the exact mechanics of these traps. By identifying them in advance, you can trade alongside the institution setting them. The core strategy is the ICT breaker block. It relies on a single daily pattern that forms repeatedly, giving you a precise framework to execute. This line chart outlines the foundational structure. You have a higher high that fails, immediately followed by a sharp drop that leaves an empty gap in the opposite direction. Master this structural footprint and you have a complete blueprint, from pinpointing your exact entry to setting your final profit target. You step out of the retail trap and start taking high-probability positions. High-probability setups require the correct environment. We want to execute during the high volatility of either the New York or London kill zones, specifically when we have a bearish daily bias on the higher timeframes. As we enter the kill zone, we identify buy-side liquidity, marked by the line labeled X. This previous high acts as bait. As green candles break above that line, retail traders see a breakout, eagerly placing buy orders, expecting the trend to accelerate. But that upward push is engineered. It is designed specifically to sweep that liquidity pool and draw early buyers into a false long position. When you see this initial sweep happen, do nothing. Keep your capital protected and wait. Patience is your advantage. Reacting to the first breakout is why most traders lose. Professionals wait for this liquidity to be fully consumed, knowing it will serve as the fuel for the actual downward move. Immediately following the liquidity sweep, we see a sudden, aggressive cascade of red candles pushing downward. Draw a line at the most recent swing low. That is the structural bottom formed right before the final high was swept. To confirm the trap is set, we need a market structure shift. The price must break aggressively below this new line. There is a strict requirement here. If a candle only pierces the line with its wick, the setup is completely invalid. It must be a full candle body close below the threshold. A heavy body closing below the line proves true institutional displacement. A wick represents nothing more than temporary volatility. Once you get that full body close confirming the shift, you have definitive proof. The direction on the chart has flipped from bullish to bearish. Now we map the entry area. Look for the last down candle formed just before the final upward sweep. That is your breaker block. Next, identify the fair value gap, the structural inefficiency left behind by the aggressive downward momentum. Draw a box that encompasses both the breaker block and the fair value gap, and extend it out to the right. Think about the trapped retail buyers. They are holding losing longs, desperate to close their positions at break-even as soon as the price returns to this zone. That desperation creates heavy selling pressure. As price retests the zone, place your sell limit order at the top of the gray box. Set your stop loss just above the combined breaker and FEG box. Finally, aim your profit target down at the nearest major pool of sell-side liquidity. By pairing the failed order block with a fair value gap, you filter out weak setups. You are trading a highly defended institutional level, backed by structural logic. The combined force of institutional momentum and trapped retail traders bailing out pushes the price rapidly down to your profit target. Step by step, you let the liquidity bait the trap, waited for structural confirmation, and executed alongside the true reversal. Remember this rule. Breaker blocks are one-time use only. Once the price taps the zone and drops, it is spent. Do not trade it a second time. Open your 15-minute charts and look for this exact pattern from the latest New York session. If you want to keep trading with the institutions, subscribe to the channel, and I'll see you in the next breakdown.